What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to the CPA Zone. I'm your host, Ryan Pulis, and today we're diving into a topic that's a bit more advanced, but good to be familiar with if you're investing in real estate deals through partnership structures. So today we're talking about deficit restoration obligations, or DROs. If you're a GP or an operator and you want to claim big losses early, think bonus depreciation with front-loaded special allocations, the DROs might be the tool that makes that possible. So we'll talk about what is a DRO, when it's used, and a little bit more. So let's get into it. So first, why do DROs even exist? So partnership tax allocations have to have something called substantial economic effect under Section 704B. So translation, if you want to take losses on your K1, you need actual economic risk to match them. A DRO is one way to create that risk. It basically says if my capital account goes negative, and we liquidate, I'll restore that deficit with cash or some other property. So that promise, enforceable in the real world, not just on paper, is the economic risk that supports larger loss deductions than your current tax capital account would otherwise allow. One common misconception is we hear, like, if I sign a DRO, is this a capital contribution? No, it's not. A DRO doesn't increase your capital account on day one. It's not any cash in. It's simply a contractual promise to potentially put cash in when the partnership liquidates. So your capital account can go negative, that's the point, and the DRO is the safety net for the economics to work. So some operating agreements allow unlimited DROs, others put a cap on it, we call a limited DRO. We'll talk about both of those in a minute. So in real life, DROs are rarely found as default language in boiler operating agreement language. So most attorneys draft operating agreements to minimize their client risk. DROs tend to appear when the GP or the operator wants outsized tax losses early relative to the cash invested. For example, when a GP is adding value through acquisition and operations rather than writing the largest check in the deal. So think of DROs as sort of a last resort. They help deliver the largest allocation of early losses, which can be very valuable, but they also attach more risk. If the deal doesn't perform, the partnership needs cash at liquidation, your DRO can turn into a real check you need to write. The two different types of DROs we have are limited and unlimited. So an unlimited DRO, you promise to restore whatever deficit exists upon liquidation. If you get pushed into a negative $1 million position, then you're on the hook for up to $1 million if the partnership needs it at liquidation. So maximizes front-end flexibility, but a lot more exposure at the end. It's very risky with the unlimited DRO. There's also limited DROs. So you can cap the obligation, say at $250,000, $500,000, whatever your number is. So your capital account could go as negative as that cap. You still get loss allocations, but there's a guardrail in place. So whether a limited DRO works for Section 704B, that really depends on how it's drafted and the economics. There still needs to be genuine risk there. Like paper DROs don't count. The IRS is allergic to fake risk. If your documents say DRO, but other provisions or side letters make it nearly impossible for you to ever pay, like someone else's commitment must be exhausted first, so there's a guaranteed source of cash out there for you, and you really don't have economic risk. The DRO also has to be legally enforceable under state law and actually binding at liquidation. So make sure you're working closely with an attorney. Now, an example of how DROs play out from day one of a deal to the stabilization. Just a brief example. Let's say you place your property in service, take bonus depreciation, allocate losses consistent with a DRO. Your capital account goes negative and you claim losses on your K1, subject, of course, to the at risk, your basis, and passive activity loss rules, which are all outside of 704B. Now, during the operating years, the partnership may generate some income or losses. Your capital account will move accordingly. The DRO doesn't require any cash during the operating years. It's there simply for liquidation. So two scenarios at liquidation. Best case, exit, property performs well, you sell for a gain, everyone's capital accounts must end at zero upon liquidation. Because your account's negative, you'll get allocated a larger share of income or gain to bring that back up to zero. And if there's plenty of cash, you won't necessarily have to put any money into the deal. Your gain sort of fills that hole and the DRO obligation is satisfied. Then the distributions will follow their waterfall. So you're going to likely recognize more income than others at exit, but think of it as sort of the mirror image of those early losses you enjoyed. It's similar to depreciation recapture logic. You get the early benefits, but then later there's a payback to kind of make things whole. Now, a worst case scenario, or if the deal underperforms, you sell for a loss, or there's simply not enough cash to meet liquidation obligations, your capital account still has to reach zero, but now there's not enough income to allocate to your capital account. That's when the DRO can trigger cash contribution from you to restore that deficit so the waterfall can pay creditors and partners per the operating agreement. That check can be pretty large, so make sure you're planning your risk tolerance accordingly if you're using a DRO. Now, here's a common scenario where we'll see a DRO. So there's a partnership where one partner, let's call them the GP, does all the hefty lifting. They found the deal, negotiated the debt, manage the operations, and then a few other partners are involved, but they're more passive. They're writing the check. So the group wants to reward the GP with more depreciation early without changing any legal ownership percentages on paper. So they have an attorney and a CPA review the deal, the economics, and determine that absent any extra risk, the outsized loss allocations don't have substantial economic effect. So they use a DRO. And a DRO is considered so the GP can take that larger loss allocation for tax purposes, consistent with the economics of who's bearing the risk. Now, there are alternatives before you use a DRO. So before you just put a DRO into your operating agreement, make sure you consider things like special allocations with economic backing. For example, maybe there's a promote or a catch-up that you can use to match the upside of your effort. There's things like compensation for services like management fees or acquisition fees. Maybe you can rebalance the ownership or use targeted capital accounts. There's also the debt structure to look at. Are there ways to adjust recourse exposure very carefully to align risk with allocations without using a DRO? So really the DRO, great tool, but it should be the tool of choice only when any other considerations don't achieve your tax and business objectives while keeping the economics of the deal in place. Now, when the deal's being drafted, you decide a DRO is the right fit. Make sure you get clarity on the scope. Is your DRO limited or unlimited? If limited, what's the cap? Specify that in dollars. Consider things like the trigger and the timings. Make the obligation explicitly tied to liquidation. You want a clear timeline for satisfying the DRO. All this should be documented and in writing. So there's also things to consider like priority and subordination. So avoid provisions that subordinate your DRO behind other guarantees that kind of makes your risk fake. Make sure everything aligns with the waterfall and respect Section 704B capital account framework. The state law has to come into play, confirm the DRO is enforceable in your state. And good accounting, maintain clean capital accounts. That's very important. Your tax capital account schedules, reconcile them and check the book to tax differences so the DRO math is always visible. And a brief example of what a scenario would look like. Let's say that GP invests $50,000 and has a DRO in place, and he claims a $400,000 loss. And that's capital account minus $350,000. And let's just say there's a limited DRO in place in the operating agreement that allows him to take up to $350,000 and go negative there. At a good exit, the deal sells at a gain. The GP's allocated the first $350,000 gain of income to bring that capital count back to zero and then participates in remaining profits per the waterfall. So no cash contribution required because there's sufficient income to allocate to this GP to fill his DRO hole or his negative capital account. Now, a bad deal, if the deal sells at a loss, the flip side of that example, there's not enough income to erase the negative capital. The GP is going to have to contribute up to $350,000 or whatever the deficit is. Maybe there was some income that can go to this GP. But so if the deficit is lower than $350,000, that's the amount he's going to be on the hook for per the DRO. He has to restore that capital account to $0 so the partnership can finish liquidating. So to summarize, DROs are neither good or bad. They're simply a tool. And when they're used carefully, they let the people bearing real risk take the corresponding tax benefits. When they're used loosely, it could end up being a deal you wish you hadn't made. So that about does it for today. If you found value in this episode, hit that like and subscribe button and tell a fellow investor. Until next time, have a great day. Are you interested in becoming a client? Click the discovery meeting link in the show notes to schedule a free call to discuss our services. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.